So where are we right now? Not too long ago, a lot of economists, including Fed economists, as well as Bank of America, others were saying we're going to a recession. They've all changed their mind. Where are you?
So I think, and I did a presentation a while ago, I called the U.S. economy the polyurethane economy because of how resilient it is, like one of those Tempur-Pedic mattresses, how resilient it is, that it's very hard to dent it. And you think about, I mean, the economy today versus 20 years ago, 70% consumption, 70% services. Think about, to create a recession, if you're 70% services, which are amazingly stable, they don't go into recession, your goods part of your economy, which is now a fraction of the economy, has to really become devastated. The other side of it, I think people misinterpret, U.S. economy is not as interest rate sensitive as it was 20, 30 years ago. People have locked in their mortgages already. The banking system runs differently. Commercial real estate gets hurt. Companies have termed out their debt. They don't rely on the front end of the yield curve like they used to, the Fed funds rate. And then the last point is, the big spenders on CapEx in the U.S. economy are companies, tech companies. They're not big borrowers. So I think people overestimate when the Fed raises rates this much, you hurt parts of the economy, the regional banks, the small banks, your commercial real estate, but the rest of the economy is amazingly resilient to it.
So it's fascinating, Rick. I guess the answer to the question of why so many people got it wrong is they had the wrong model. Do we have to revise our economic models going forward for the reasons you just identified? It's a different economy than it was 20 years ago.
100%. By the way, now is a different economy today. So we try and model and project what inflation is going to look like 2-3 years hence, let alone for the next year. Think about now how the economy is evolving around AI and productivity and how jobs are going to evolve. Very hard to think about economies. People look at the analog from 10 years ago, 20 years ago, and what happens when rates move. I think you have to look, I mean, we're trying to spend more time on is environmental conditions that you're operating within and what impacts it. Another way, you talk about, we have a need for more people. The unemployment rate sits at 3.5% is a structural reason. You look at, and we've talked about on your show a bunch of times, you look at the number of people hired for healthcare, education, not interest rate sensitive. There's a shortage, leisure, hospitality, hotels, restaurants. There's a shortage of people. When you have a 3.5% unemployment rate, because it's structural, it's pretty hard for the economy, at good wages, pretty hard for the economy to go into a deep recession when so much of the economy is consumption.
So let's take a look at the investment profile, given what you've just said. Where does the 10-year want to be? Because so many investment decisions are really keyed off of where the 10-year yield is. Where does it want to be right now? Because I hear people saying in the mid-3s, low 3s. I hear people say in the mid-4s.
So, I think, around 4%, I think is a reasonable resting place. My sense is there's a couple of factors that work against one another. The first one is Treasury's issuing an amazing amount of supply. We're going through the issuance, and the Treasury just announced they're going to increase the supply longer on the curve. They relied on immense amounts of Treasury bills. You're seeing this almost $300 billion a week gross supply, not net, but gross supply of Treasury bills. So you're going to get more supply. So that tends to push rates a bit higher. However, inflation is coming down. You look at the CPI data, and I was looking at the 3-month moving average of core CPI. If you strip out some of this funky used car stuff, is only 1%. So now you take, okay, so it's actually 1.1%, 3-month moving average. So you say, okay, 10-year note now, the real rate net of inflation, it's not bad. I mean, the level on 10 years. So I don't think we're going very far. I think the supply could push 10 years a bit higher. If you said to me where are we going to be 6 months from now, 9 months from now, a year from now, I think the 10 years is going to migrate lower, because if you believe that inflation is coming down, which I think is right, then the 10 years should start to move closer to 3.25. And I think we'll see that next year. But, for the next couple of months, it's sticky at these levels.
We had so many debates about hard landing, soft landing, what kind of landing. You suggested maybe we may not have a landing at all.
Yeah.
So given that, does that change your investment outlook right now? Does it change how you invest your money?
So I got to say one thing about it. I mean, I think the economy is moderating from extraordinary 12.3% nominal GDP in 21, 7 and change percent in 22. That is unbelievable. I'm not saying we can't slow a bit. And, even could you have a technical recession? I just think you'd have to wake people up and tell them, because you're operating at such a high level in the economy. So how do we think about it? Listen, I think there are a lot of, equities that make sense today. The equity market's had a really good run. 7 stocks, 8 stocks have driven it. There are a lot of companies. If you believe the economy is stable, you can buy a lot of businesses that trade at 3, 4, 5 times cash flow. If you believe the economy is stable, autos, airlines, home builders, some of the energy infrastructure trade at pretty low multiples. So I like owning the equity market, so I like running portfolios. I think you have upside in equities. And then you can create amazing amounts of carry. The front end, I talk about the front end of the yield curve, you can buy commercial paper buying 6%. If you can create a 6 and then own some equity, and by the way, it gets to your point about do I need to own a lot of 10-year or 30-year treasuries, that at 4, like, I don't know, not that interesting, but I can buy a lot of front end, a lot of yield, and then buy some equity, and so get some upside with some real income.
On the equity front, talk about the discount rate, because we're up now north of 5, right?
Yeah.
Some people think it's going to come back down next year fairly quickly. Other people think it may stay up there. That really affects the value of those equities and the valuations you're talking about, doesn't it?
100%. And so, by the way, my base case is that inflation is moderating. Those real rates we talked about should come down with a Fed that is now stable and will start cutting rates. So I think the equity market next year will get a nice boost from what I think will be a reduction in the interest rate. By the way, credit spreads are also really tight. Companies don't borrow off. They borrow off of their spread to treasuries, and they're pretty tight. So the discount rate is not bad today for equities, but it is, my sense is it's going to come down from here.
So you were anticipating Fed cutting rates next year.
Yeah.
I mean, how early and how much?
I mean, I think the Fed would like to stay on hold for a period of time. But I think as you get into the second half of the year, then and maybe earlier if inflation decelerates quicker, can you start to do 25s a meeting? I think so. I think these restrictive rates, my sense is, I would talk about your show a lot. They're because the economy is not as interest rate sensitive as it used to be. Those restrictive interest rates really hurt small banks. They really hurt commercial real estate. They hurt targeted parts of the economy, which quite frankly I think have been overdone. And the other thing they really hurt is the U.S. government is running over $30 trillion of debt. The Treasury has usually borrowed its Treasury bills at 0, with a huge part of their borrowing scheme is at 0. Now it's at 5.5%. The debt service in this country will choke the amount of fiscal spend that we can have in the country. The Fed needs to bring the rate down so that we don't create too onerous a problem in terms of debt service in the country.
Since we last got to talk to you on Wall Street Week, you've got a new gig.
Right.
It's an ETF.
Yeah.
Tell us about the ETF and why you're doing it. What's the itch that you're trying to scratch that hasn't been scratched?
So there is, the explosion of ETFs. People use them in so many different ways. You can trade them all day. They're tax efficient in many ways. People like to put them in models. They say, I've got this ETF, they buy and sell. Anyway, so we've been asked to do an active ETF, and so there's been a tremendous growth of passive ETFs, both in credit and rates, et cetera. And now you're seeing more people want active. So in fixed income, most managers outperform indices consistently over time for a variety of reasons. There's 68,000 fixed income securities. Compare that to the S&P 500. There's so many tools we have, and so people have asked for, gosh, I'd love to get the exposure in an ETF form. Give me something that can get me a little bit more juice. And so in this new one we're doing called BINC, it's a 7% yield. We manage, sometimes we're in securitized assets, sometimes we're in high yield. We move it around tactically, investment grade credit. And to get that sort of yield and have somebody, it's hard as an individual to buy securitized assets. You can buy CLOs or commercial mortgages. To many people, like evaluating the collateral is hard. And so, we've been doing it for a million years. And so anyway, it's becoming really attractive, and there's a lot of excitement around it. So
Rick, explain the mechanics of this. We hear so much about private credit and the growth of private credit. How does something like your ETF interact with the big private credit guys?
Wow, that's a great question. So private credit today, you think about how the world has evolved. We talk about carry and we talk about income you can get today. Private credit now, versus private equity. Private equity is hard because you can't, with rates where they are, with the public market rates, because we can create a 7 in liquid markets. We talk about through this ETF. Now private credit's got a price behind that. And by the way, private credit incorporates also real estate financing, et cetera. You can get private credit at 10, 11, 12% with real collateral, real covenants, and create a really nice structure. So I think private credit's going to grow the next few years. Harder for private equity when you have to finance at 12 than when you financed at mid single digits, mid to high single digits. So it's a really big deal. I think private credit will be, you'll see a lot of people, buy things like, the ETF where you can come in and out of it, get some real yield, and then also say, private credit, I'm going to own that for 3 years, 5 years longer.